Well, good evening, everybody, and welcome to the Mid-Michigan Manifest Investing Roundtable. This is our August version. We've been at this now for, it seems like a long, long time, but it's at least more than 10 years. We're looking at Ida as it slammed into Louisiana, and our thoughts and prayers, and I would hope maybe some of our charity is going to move in that direction to help some of those people down there. It's a terrible, terrible thing what's happened to some of the locations in Louisiana from a storm that originally was supposed to be a Category 2 when it moved into the landmass. I'm here this evening with my good friends Mark Robertson and Cy Lynch. Mark from Rochester, Michigan, and Cy Lynch from Atlanta, Georgia. We're going to be joined momentarily by our friend Kim Butcher, who's down in southern Florida. And Hugh McManus, as you might be aware, his job is keeping him extra busy right now as things start to open up and as we start to get final approval for vaccines and we start to look at some of the other kind of things, other kind of pharmaceuticals associated with COVID. So Hugh's not going to be with us this evening, and I would imagine that he's making up for some of that leisure time that he had in the last year and a half, right, Mark?
Absolutely.
We can go to our normal disclaimer real quickly here if you'd like. Everything we do this evening and at all roundtables is for illustrative purposes only. We are going to be talking about real companies in real time, and we might even own some of those companies. If we own the companies, we'll do our best to let you know that they're in our portfolios. The roundtable is sponsored by Better Investing Mid-Michigan and by Manifest Investing. And if you'd like to be added to a reminder list, you'd get one email a month reminding you to register. Then you can send an email to ncavula1@comcast.net. That's my wife's email. She'll add you to the reminder list, and you'll get a single email from her each month reminding her to register, if you wish, for the roundtable. As always, copies of these slides will be posted on the YouTube channel. Search Manifest Investing Roundtable on YouTube. You should come up with it real quick. Once you get there, why don't you actually register for the channel? Put your name on the list so that we can put together a group of people that are going to be watching what posts there on a regular basis. And if you want copies of the slides from tonight, send an email to Mark R at manifestinvesting.com, and he'll send those slides right out to you, and you can do with them anything you might be asking or wanting to do with them. I think I covered everything on this slide, Mark, so let's get to it this evening, okay?
Yeah, we heartily recommend that you get the slides and laminate them and put them on your refrigerator.
This is our normal agenda. We are going to talk about our performance results. We're following a portfolio that we've been tied to now for lots and lots of years. We're quite proud of the performance of the portfolio, and we're putting it out there for people to take a look at. I think it shows that the better investing method of investing works, and it works well when you're consistent about it and when you do some serious thinking about the stocks that you want to put into the portfolio. We're going to look at a few stocks that might need a little bit of challenge this evening. And then there's 3 presentations tonight: Malibu Boats, MKS Instruments, and Boston Beer. We'll take a poll at the end and find out which one you think belongs in the portfolio as an extra to what we have. And then we'll move into open questions and answers. We try to make this stay to maybe 60 to 70 minutes. So let's see how good we are at it this evening, okay?
Before we start, Ken, I want to enter a protest that you and Mark are obviously conspiring against me. I have science and hard, STEM hardcore investments, and you pick boats and beer.
Boats and beer. What do you want?
Yeah. So.
We thought we'd come up with a combination that goes together this evening. Okay.
Yeah, and everyone should remember that beer and cereal are closely related and go back as far as ancient Egypt, and beer is just nectar.
He's going to run off and lobby for himself now, Cy. Okay.
It sounds like it. Yes.
All right. This is a demonstration, folks. The demonstration is to show that without a lot of work, you can put together a portfolio. Our goal is to beat the market benchmark. We're using the Wilshire 5000. Our goal is to beat it by 5 points or more, and to do that over a consistent period of time. We'd love to see that happen for years, not weeks or months. We'd also like to see over half the stocks that we pick outperform the total stock market. Our goal is to move up to 60% of the choices outperforming. And we've been moving in the right direction long term. Even this last month, you'll notice that we turned around from a bottom that we had hit. We had moved under 4%. Looks like we moved right back to, are we right back at 4? Oh, we're at 3.9%, okay? So we're moving back towards that red dotted line, which represents 5% better. But I want to tell you folks that if you can only beat the market by 1 percentage point, then you're doing better than so many of the professional investors out there that are managing funds and putting money to work for their clients. Even a 1% beat of the market is statistically significant, and it will result in quite a difference in the size of your nest egg after 25, 30, 35 years. If you can push it up to 2 or even up to 5 or more, as better investing suggests, then of course more money's in the pile for you to deal with. And we're at 3.9, overall rate of return 18.9%, while the Wilshire 5000 is at 15%. And that's over, it's more than 11 years now, right, Mark?
Yeah, we're entering our 12th year now.
Okay. Our outperformance accuracy, 52.8% of the stocks that we've chosen have outperformed the market since we made the choice. We're moving, our goal is 60, but certainly anything over 50 is again a real good way to put a portfolio together. Where are we going next, Mark?
Well, let's take a look at the portfolio. We're basically looking at just the top 20 holdings by percent of assets. The legend up at the top provides a clue as to how many times individual stocks have been selected. So, for example, Cognizant Technology has been selected 15 times, 14 times by Cy, I think is the legend around here. And that Cognizant, that $15,000 invested in Cognizant is now approximately $28,000. So that's how you can basically break it down. Microsoft, a 5-time selection, so $5,000 invested, has become approximately $77,000. So having a pretty good run. This is how you get to 18.9%. A lot of household names, but there's also a number of companies that are a little bit further off the radar screen for many investors. And Universal Display comes to mind. I believe that's a 4-time selection in 4th place there. And we picked it one night along with the audience. So $3,000 invested on that first night plus another $1,000. $4,000 has become nearly $27,000. So that one's been a pretty good run. Anything else jump off the page to either you or Cy?
I like the fact that Costco continues to stay on this top list, even though it's a one-time pick. It's certainly giving us direction about how great that stock is and how consistent it is. Only been picked once by Hugh McManus, I think, quite a while ago. And
Yeah. 1 month
so
into it's 11 years old.
yeah,
Yeah,
we've
that's
turned
right.
$1,000 into $9,500. That's a really nice way to make things work.
And I do think we should give a nod in the direction of Rsi and his desperate selections of EPAM systems, because he didn't want to pick Cognizant too many times. And EPAM is actually running the table. And we're having a pretty good run. So thank you, Rsi.
My pleasure.
We should also point out Amazon, which is only a two-time pick.
I was just looking at Amazon.
And what is that, fifth, sixth on the list right there? Only been picked twice. So that's $2,000 going to $23,300.
Yeah.
And again, I know the first Amazon pick was Hugh again.
All right. Something interesting about, to some extent, Universal, because it's fairly new as well, but EPAM is relatively recent. I think Amazon is relatively recent when you're talking about 11 years. As you mentioned, Costco is a one-time 11-year-ago pick. That's just kind of slow and steady on Costco.
Mm-hmm.
And while it's doing way better than 1 percentage point above the market, Ken, it's a way of demonstrating what you were talking about. You know, the power of compounding over time. I mean, because
Absolutely.
realize in 11 years, given our goal of beating the market by 5%, now recently that's probably a little under 15%, but let's use the roughly 15%. That the market returns about 10% over the long term. 15%, that would have been 4,000, maybe 5, depending with the 11. So, you know, it's kind of doubled that. But my point being, that's just kind of a decent return. That's nothing spectacular in Costco.
Right, especially compared to some of the other things that we show on our list here. Yeah.
Exactly. I mean, it's still an outstanding return relative to the market. I'm not, but yes, relative to the Universals or the EPAM or the Amazon, you know, it's just a nice, good, steady plotter that makes a lot of money.
Okay, well, I did a little bit of reconstruction, Ken, and I thought you might want to kind of lead us through looking at the portfolio from this perspective. We've got the report card on the left, and then on the right is basically the worksheet sorted by from lowest return forecast or par, and including the ones that are basically under the average return forecast for the market. So what are your thoughts here?
Well, we start with par. We'd love to have our par for the portfolio up around 12.2, 12.3. At the lower end of the sweet spot at least. We are 2.5 points or almost 2.5 points above average. So it's a good par, but it's a problem that many of my portfolios have been having in the last year and a half, 2 years, and that's trying to keep the par high enough. That's a function of stocks doing really well and stocks in my portfolios moving their pars down to under my par. I don't hate when that happens, but it's been very difficult to keep the par moving above the sweet spot, and that means constant kind of watching to see what needs to be moved out of the portfolio and what you can replace it with. At the same trying to maintain quality. Quality is certainly great for this portfolio. And growth, you know, growth is pretty decent for the portfolio. We were having a problem with growth a couple of years ago, and we focused on growth. So maybe we need to start to focus on some higher par stocks and move them into the portfolio as well. Financial strength is good. EPS stability, a little bit lower than I would prefer, but still in a pretty good range. And I'm looking I would definitely consider Adobe, EPAM, Infosys, Costco, Forward Air, Bristol Myers, Schwab. I think those are all probably paychecks as well, probably what you would call core stocks. I don't see many non-core on here. I might identify Illumina as non-core, and I might identify Booking as non-core. And I think Booking, I'm saying it's non-core only from the point of view that I think this is a stock in a category that's going to have to wait a little bit more to catch up to where it was. Now, price-wise, it's certainly above where it was in 2019, but it still has to recover an awful lot of its business. Travel is still very tenuous, with Europe talking about closing down their borders to Americans again because of COVID. Travel all over the world is something that is yes, no, maybe. So I don't see many adjustments to make right now, Mark. How about you? Do you see anything that you would want to adjust?
Yeah, what I would like to do is I'm having a really rough time with A2 Milk, Mercury Systems, and Biomarin Pharma, and I'd like for us just to remove that from memory and just forget that I ever brought them up. No, I'm kidding. No, the only one that I can see that really comes in under some level of duress, and it's a good thing because Illumina has just been on a tear, but it is such a wild roller coaster. We'll take a closer look at it here in a minute in the slides. But it is hovering near a low single-digit projected return, and it has a fairly high PE ratio. We'll see how that's not unusual for the company. And it's in that class of companies. What's your other company? Computer Systems. Trying to think of the name of your small company that's in biotech support, gene research, and that kind of stuff. Anyhow, it doesn't matter. It's in that class of companies that we know. I mean, Illumina's done great things in the pandemic solution side of things. So it's had quite a run. So we will take a closer look. A2 Milk, it falls under the microscope. It's the stock price has actually dropped from 5-something down to the low 4s, and they've actually, because of the Chinese situation, they've just been really struggling. That's a milk producer out of New Zealand, and there are rumors out there that Nestle is strongly interested in the company, so that may be a reason to hang in there, but it's just not performing very well, thanks much to the infant milk in China actually being shut off for the most part. Ardelyx, of course, had the failed FDA situation, so we've got 5 or 6 positions in Ardelyx that went from $9 a share to $1.50 in about 10 minutes a month ago, so that one's actually underperforming badly. By the way, it was second on the list in terms of total assets, and it's now not even in the top 20. So just a few things to think about. On the RSI Greater, go ahead.
Mercury Systems has certainly disappointed me. I have it in my groundhog portfolio, and it's the worst performer in there by far. I don't see any reason for it to keep moving in the negative direction. Looks like an escalator moving to the basement. But I like the concept. I like what they're supposed to be doing, but the management is having a terrible, terrible time turning any kind of revenue into something on the bottom line. So it's one of our small companies on our small company list, and it's just not loved by very many people right now.
Yeah, we probably want to throw that one on the pile and look at it closer next month also, and see if that degradation continues. The other category that's shown here, RSI greater than 80, that's simply meant to flag stocks that are particularly hot And thank you. I picked Globant a little over a year ago. That actually, I'm not sure how that escaped the attention of Rsi because they're sort of in a related business to Cognizant and EPAM. But that one has taken off, and we'll take a look at it. I'm wondering if maybe we shouldn't consider a trailing stop limit order on it. So let's take a closer look at that one, and we could talk a little bit more about Illumina. As I've got a slide on that one too.
Well, before you move off that, Mark, the one that you didn't mention at all is BP, and I'm finding a new reason to keep BP on our radar at the moment. It's one of the most significant players in these electric recharging stations, building networks across the country. It's a very significant player in that particular ballpark right now. So not the electronic vehicles themselves, but the charging stations. And I can see where their management is going. You know, if fossil fuels are going to be moving to the back seat, then we're going to need something to replace revenues. And what better way to do it than by good old-fashioned, call them something else now. They won't be gas stations anymore, and they haven't been service stations for a long time. So, but these units all over the place. I was up in Traverse City a week and a half or so ago, and saw a bank of a dozen of these things just sitting in the Meyer parking lot. They were all branded Tesla, and that's another major player that you don't think of as moving in that particular realm at all.
Sure. Yes, I think of BP. BP was one of the stocks that Hugh doubled down on, along with companies like United Airlines and a couple others that really did get a pretty good bump because they were just hammered so badly. But they actually have lagged the market since March of last year. As you look at that entire class of recovery companies, whereas virtually every stock on the planet seems to have outperformed since March 2020 in relative comparison. So it's kind of weird to see that.
Mark, what's the TSLO after Globant standing for? It's probably obvious, and I'm just not thinking of it.
Thinking trailing stop limit order. That's what we refer
Trailing
to.
stop limit order. Okay, yeah, I got it.
For Roman candles, and here's the Roman candle I wanted to talk about. Picked Globant a little over a year ago. They're a consulting company, much in the vein of a EPAM or Infosys Technologies. I believe they do a fair amount of business in Latin America, but they are global, and they've just taken off and done extremely well, especially in the last month or so. So, you know, much like a Roman candle, if they were to flame out, we wouldn't want to write it all the way back down. And I'm thinking maybe we demonstrate the use of a trailing stop. This is the type of company that you can, you know, don't necessarily have to name members of your family after it and that sort of thing. Don't have to become too attached. So it could make some sense to put in.
Mark, 8%, 10%? What are you thinking?
I'm thinking 10%. If it drops more than 10%, we just high five and walk away. And if
I can support that. Yeah,
it keeps going up. So maybe that's a way to demonstrate trailing stop limit orders. You don't want to put trailing stop limit orders on the vast majority of your stocks, but this one probably qualifies. So let's go ahead and experiment with that if that's okay with you guys.
What's the PE sitting at this point right now, Mark? Do you know?
I actually don't know.
Okay.
It's
all right.
Go ahead, Si.
No, I was going to let you finish the PE answer because I don't know the answer to that. I was going to make an observation about the trailing stop loss.
Okay, go ahead with the trailing stop loss because I don't know.
All right.
I'm trying to look it up.
I haven't really harped on them too much in a number of years, but stop losses I have a fond name for called guaranteed loss orders. The one exception that I've never personally used, but where they can make sense, is a high momentum driven stock that has a chart like this. It, you know, and you don't really know if you're willing to give up 10% off today's price as the cost of doing business or realize maybe a little bit more if it falls hard, it makes perfectly good sense to use a stop loss, trailing stop loss to me. But I'm glad that you mentioned that's a very rare situation. And, the whole stop losses to protect your downside and that sort of thing, those are guaranteed loss orders.
Yeah, our audience is wonderful, Mark, and we're getting Bonnie and Marie and Dean, and they're all telling us that the PE is listed as better than 180 right now.
Oh, okay.
So that again is a great, either sell it now and love the 180, but it's still going straight up. So, Robinhood and those guys may jump on it. So
Yeah, we'll get
trailing stop loss might make sense.
We'll get Sean to push it on Reddit, so do a little promoting. All right, here's I'll hear about that one tomorrow.
Yeah, you will.
All right, so here's a look at Illumine. Again, this is the company that does a lot of the research, the hands-on research and support for drug development, discovery, and commercialization, that type of thing. No stranger to many of us. Looking at a company in the mid to high teens and with respect to growth. This data is all fairly current. So at a growth rate of 16% and margins, somewhere in that 20% range, you are looking at a company that has a very low, basically single-digit return profile, decent quality, very good company, but a fairly low projected return on value, which actually bolsters or, somewhat validates the selection of that PE ratio. And I could see walking away from it and just basically taking our win. The thing that kind of stunned me, and I know you're in clubs that actually hold this one, Ken, that thing has gone like from 300 to 550, and it went. In fact, 2 weeks ago it was at 490, almost 500. Today it's at 450. It was 550 just a few months ago. It has to be quite the wild ride for anybody that actually is a shareholder and quite rewarding over the long term.
I brought Illumina to the roundtable quite a while ago, years ago, and we put some of it in one of Natalie's IRAs, and we just quietly tucked it away and ignored it because I think this is the kind of stock that I at least want to own. They have so much money put into research and development, so many patents, and from my point of view, at least, so many things that I don't understand that they're trying to discover and trying to make better. Their original goal was to bring the time to sequence the human genome down to minutes or hours rather than months or years. And they accomplished that with a lot of their machinery and a lot of their technology. And they're moving on. They're not taking and leaving the genome, but they're moving on to different kinds of things to look for. And like I said, I don't have any idea where their discoveries will lead them, and I don't have any idea what they're doing because they don't trumpet it from the rooftops. Maybe part of it just to keep their own secrets within their own company, but I'm going to hold on to it, even though the par is only at 2.7. I'm going to hold it for. I'm an old guy, so I can afford to have some clunkers in my portfolio.
Well, do you close your eyes on roller coasters?
Yes.
There you go. I mean, this is a close your eyes on the roller coaster type stock, and maybe we just grit our teeth and hope that type of thing continues.
I truly enjoy roller coasters, but I do close my eyes, and my wife won't even go on a roller coaster, and yet we're both pretty comfortable with this particular stock, only because it represents, to me, the best that science can do. I mean, there's a limited list of companies that are moving on the cutting edge of human biology, and I think this is one of them.
Okay, any thoughts, Si?
I try not to close my eyes on roller coasters. And, you know, I certainly think I do not know much about Illumina by itself. And, you know, I can't being the patient, the guy who pleads for patience and long-term and everything. I hear Ken, but for most of us, it certainly makes sense to me if it's a roller coaster and bounces around that you say thank you very much, take the money, and then consider buying back into it 6 months from now.
Dan Hess is out there.
181 PE is, I mean, EPAM is low at 93. My goodness.
Dan Hess is out there suggesting that Illumina is a favorite of Kathy Woods. I never thought that I would be sitting in the same room as Kathy Woods, but there we go. Cutting edge kind of stuff.
That's a great point that Dan makes, that she's not having a good few months, but she's had a really good 5 or 6 years. So I tend to look that way too. All right, well, we can continue.
Thank you, Marie, for correcting me. It's Globant that was the 181. Illumina is down low with EPAM at 87.
Yeah, it's beneath EPAM, Si. Come on, okay?
All right, well, we're running up against 9 o'clock, so we can press on, but I think we should just continue to close our eyes on this roller coaster and go for now. Yeah, there's the picture of the roller coaster. I just find this amazing. I mean, a year ago it was at 550, less than a year ago, earlier this year. And now it's crunching along at 457. Here's the long-term look. So you can see it's definitely some roller coaster activity. So this is one of those stocks that you shouldn't be surprised anytime the price takes a breather for a few months, because it's taken several breathers along the way. Anyhow, all right, so let's go ahead and go to the stocks. And Ken, you can start beating up on Rsi with your boat company and recreation.
Well, I will tell everybody out there that I don't own a boat, that I've never had the urge to buy a boat, but I have lots and lots of friends that do own boats, and they think this is quite a well-managed boat company, and they also like the products a lot. If you don't recognize the nameplate Malibu, you might recognize one of their other brands. They operate under 5 major brands, and Maverick operates under a group of brands itself. So lots of different nameplates, all coming back to the same company. Next slide, Mark. Malibu's growth strategy is pretty simple. They'd like to fill in the spaces with products that they don't currently have on the market. When they find something that's new, they like to create boats to fill that space. One of the newest trends right now is wakeboarding. I had never heard of it, but you get a boat to go fast enough, and then it's basically like a short surfboard, and you ride the wake with this short surfboard. It's not attached to the boat with a rope in any way, shape, or form. Malibu is really into vertical integration. We'll talk about that just in a second. And they're not afraid to make strategic acquisitions. In fact, some of those companies that you saw in nameplates were bought whole and then integrated into the company. The most recent being Maverick Boats. The integration of Maverick has just finally been completed, and they've added an awful lot to the top line and the bottom line with the acquisition of Maverick. Next slide. Vertical integration means making a lot of the things that go into the boats, and this is a strategy that Malibu is working very hard to increase, so that their boats are made up of a lot of pieces that they also make. Flooring, for example, is a relatively new product that they tested in Cobalt boats, and it worked really well, and they're going to move their own flooring into Malibu boats and Axis boats in the coming fiscal years. They're looking to do 2 to 3 additional vertical projects every year. There are always 2 to 3 projects in the works, and they feel these are giving them a lot more opportunities because some of these products actually have patents attached to them, and those products are protected. And if they're going to be sold to other boat manufacturers, they're going to come with a hefty royalty. Next slide. You can see the mix. Cobalt was their primary seller in fiscal year 20, but you can see Cobalt is moving down in the pie chart right there from 30% to 23%. And the piece of the pie chart that's expanding is saltwater fishing boats. These are larger boats because they're going into the ocean itself, and they carry a more expensive price tag, and they come with much higher margins. So Malibu is not only aware of selling boats to people, but they're aware of the business model and making a profit for their stockholders as well. Next slide. Full year outlook, they're looking for high teens growth in sales. That's the only thing I wanted to point out on this slide. Next slide. If I bought Malibu boats today, I would be buying, we're looking at a chronicle of Malibu boats from Manifest Investing, and I'm looking at the blue line. There were times in the last 4 years when the quality was just so-so for this boat company, but that blue line, and we have a little bit of something needs to be tweaked in the manifest. There we go. Mark's finishing the quality line for us right now. That blue line is certainly at a high level. And what's more important is I think that the par value that I'd be looking at right now for Malibu boats is probably at or near the high par value for the whole month. Mark's actually circling the par value at the end of July, and the par value has gone back up again a little bit for August. We'll be getting another data point on this graph real quickly because today was the last day of August. Next slide. I looked at 7 data points. I wanted to get that trend line to lie under the most recent data as well as I could. And so I truncated the graph and cut off 3 of the older years. Notice Morningstar has given us a 5-year growth estimate for earnings at about 25%. That's an extremely aggressive number. Next slide. 7-year history. Now I'm measuring those trend lines that I created on the visual analysis, and the top box of data shows that sales for the last 7 years have been growing at a little bit better than 28%, and the historical earnings have been growing at about 33%. It's not as straight as you might want it. It's a little bit choppier than some of the companies we look at, but it does carry a very high quality rating. And I like those kind of growth numbers. Here's the value line annual rates box for Malibu. And you can see that they're suggesting sales might be somewhere in the 13 to 14% range for the next 3 to 5 years. Earnings might be somewhere in the 18% range. Again, pretty robust numbers for a company this size. Next slide. I went to Yahoo and I looked at some of the numbers sitting on Yahoo. There's a current year sales growth number and a next year's sales growth number. That'd be 2022 sales growth number. I added them together, divided by 2. That's a 30.25% 2-year sales growth number, a pretty aggressive number, I must say. Next slide. Here's coming from Yahoo as well. This is down near the bottom of the array where they give me a next 5 years earnings growth. They don't identify earnings growth in front of that growth estimates, but this is earnings growth. And they're giving me a 5-year number of around 15%. That's certainly sitting in the ballpark with the rest of the numbers I'm collecting. Next slide. Here's Zach's numbers, and I'm looking at average 2-year sales numbers of just under 15% and average 2-year earnings numbers of about 13%. So while the sales numbers appear to be coalescing around 13, 14, 15, the earnings growth numbers for the next 2, 3, 4, 5 years are all over the place for this company. Next slide. I finally decided to use a 15% number for earnings. That seemed to be pretty fair with all the data I collected. And I used an 18% earnings call for earnings, again, trying to put myself at the low end of the sample. Remember, that number was as high as the high 20s and even into the 30s. I'm making a special point. I talked about the acquisitiveness of Malibu Boats, and you can see that they're willing to take on a lot of debt. Look at 2015, and then they're willing to pay that debt off on a nice regular basis. They've certainly brought that debt back down to something that's very, very manageable. And I would expect that kind of up and down pendulum kind of a swing in debt to continue to occur. Malibu makes no bones about the fact that they're going to acquire when they can find companies to fill niches that they don't presently have a boat in. Next slide. One more slide, Mark. There we go. I did adjust the PE values a little bit. I decided that 2018 I was going to strike them and see what the lower averages were when I struck those two. And I decided to use those two lower averages, mainly because they bring the value for forward PE down to something that's very similar to the last 3 years of PE. So I'm using 18.7 and 9, that's 8.2 in my SSG. Next slide. And they don't pay any dividends, so I didn't have to worry about payout ratio. Comes out to be a buy, a nice upside downside, a nice total return, a nice par value of about 16%, 16.2 in my SSG. I always use Manifest as something to validate my SSGs, to help me verify that I'm doing a study that makes sense. And I really like it when Manifest and my study are within 0.2% on par value. Manifest is at 16.4. So I'm very comfortable with this study. That's certainly better than the average par for our portfolio right now. So I think Malibu would be a great stock to add to the portfolio. I don't think there's any more slides, Mark. No.
No, I just put in this transitional slide just as a tip of the cap to Charlene Hansen up in the Traverse City area. Charlene actually presented Malibu at the Successful Investing 3 conference back in May. And you can actually go back and bolster what Ken has had to say by taking a look at what Charlene had to say. Again, these are available on YouTube, as Ken was mentioning a few minutes ago. And you can go back and look at these to your heart's content. And all 3 of the panel sessions, here's the other one here and the other one back here, some spectacular choices in this one from a year and a half ago. Our average is 27.9 right now. We like that. So with that, let's switch gears to something that isn't food related or fun related, MKS Instruments.
All right, but it makes money, which is important. And remember, when boats flip over, you get wet, all wet, and you might even drown in hard seltzer or hard soda if you were carrying Sam Adams hard Mountain Dew or seltzer.
Whatever it is they make, right, Si?
That's it. Yes. So let's talk about something for real. MKS Instruments. You can see sales growth pretty steadily up, a little bit of sensitivity to business cycles and adjustments for who they serve, but a little bit volatility in the profit margins, but moving in the right directions. And you see the value line 18-month projection is a decent 30% return from about today's price. This is a couple of months old, but it's not too far off today's price. Because the price has come down a little bit over the last couple of months. Next slide. As I do usually, I take a look at industry, quick industry comparisons. Here's looking for high quality, in the industry. And of course, all of those blues are pretty equal. Trimble down at 80, might be a little bit lower relative to those high 90s, but all of those are very high quality, solid companies. MKS is right in there at the top. Next slide. Ranking by return in the industry, you see another roundtable holding 2.6 is there, and MKS, and those are the only two stocks in the industry that right now are attractively priced in the green zone, or the sweet spot of at least 5 percentage points over market and less than 10. And of course, there's none above the sweet spot. Next slide. For those of you who don't remember, what MKSI does is they develop and manufacture and supply instruments for gases used in semiconductor manufacturing. That was their core business, essentially measuring and regulating gas for the semiconductor business. They've expanded out of that that niche, which is their core business, and have through strategic acquisitions, not unlike Malibu Boat, sought to expand this expertise into other related manufacturing processes that you can see at the bottom: fiber optics, flat panel displays, lasers, solar cells, and other similar things. Next slide. Here's what they actually make. Again, pressure controls and gauges, and measurement, again, of gases, vacuums, and then valves to control all of those sorts of things. Next slide. Here's what MKS Instruments is seeking to do. They're moving into their advanced markets, that being the solar panels, the flat panel displays, the laser markets, and so forth, seeking to find out where the technology is going in semiconductors and related business. Everything is getting smaller. All of the manufacturing processes, in semiconductors and the LEDs and all of these other things, everything's getting smaller so you can fit more and more into a given space. MKS Instruments is focusing on that miniaturization and seeking to be a leader in their markets. Next slide. Here's just a bit of a comparison to show you what they have been doing over the last 5 to 6 years when they've been moving into the advanced markets. You see in the right-hand column their growth in revenues. Notice that their semiconductor core business has grown 20% very good to begin with, but the advanced markets have tripled in that time at 30% a year. Leading market categories, that's markets where they're either the number one or the number two company with market share. They've more than doubled the categories. They've more than doubled their patents, and again, have grown their non-GAAP earnings very strong. Next slide. I've already alluded to the semiconductor core business in the advanced markets, and I'm not going to read the slide to you. You can see it. In 2020, the semiconductors, a little over half, not quite 2/3 of the business, moving toward the half level, and the advanced markets are 40% and increasing. And again, those are industrial processes, and they are getting into the life and health sciences as well as defense and research areas, in addition to semiconductor businesses. Someone last month asked a question: if the worldwide semiconductor shortage that we're experiencing right now, if that could cause problems for MKS Instruments, I would suspect the exact opposite, that the longer we experience semiconductor shortages, the more the manufacturers are going to try and address that shortage and potentially ramp up by buying more equipment to manufacture or more efficiently manufacture semiconductors, which could well benefit MKS Instruments. Next slide. Here's their story. They're, again, transforming the business from just semiconductors into other areas, then buying. They are an acquisitive company. Most of these advanced areas they've entered by acquisition. So they bring them in and then cut costs primarily, and cross-marketing and so forth to bring about synergy and good financial results. They really focus on generating cash flow, which they then use to pay off the debt used for acquisition. That could well be similar to a model that Malibu Boats was doing, perhaps. Ken showed you the great increase in debt and then paying off. MKS's is not quite that radical, but that is their strategy. By using debt, generate cash, and use the cash to pay debt down and to produce long-term earnings growth. Next slide. Again, just another way of looking at what you saw in a previous slide for growing revenue in excess of 20% and EPS in excess of 25% over the last 5 years. Next slide. Here's that cash flow that I was talking about. You see, this is just a graph of cash flow, and they point out that in 2019, cash flow dipped rather dramatically, but it was higher than just about any peak prior to 2016. So again, very strong cash flow generation. Next slide. And I've already mentioned what they seek to use strategically their cash flow to do, and that is to acquire related businesses. Newport and ESI are their two most recent big acquisitions into those advanced markets, and they also use it for R&D, capital expenditure, paying dividends, and buyback. But again, much of it is in acquisition. Next slide. Just showing how they have increased profit margins in their acquisitions. That's the synergies that they were talking about, how they bring in a business that maybe is not operating at quite peak efficiency and use their management and their manufacturing and other processes to increase profitability. And the Newport acquisition about 5 years ago, you see a significant increase in the margin there, and even greater increase in margins for the later acquisition, ESI. Next slide. Here's roughly what they're looking for. They're looking to exceed the semiconductor market. That's that WFE is wafer fabrication equipment. That's an industry measure. They're seeking to grow faster than the industry for semiconductor wafers, the core of semiconductors, by 200 basis points or 2 percentage points. And then the advanced markets are seeking to grow 3 percentage points or 300 basis points greater than the U.S. economy, measured by gross domestic product. And then you can see some other projections that they have, and they're seeking to grow their non-GAAP earnings per share twice as fast as revenue. And that's again by margin expansion and some stock buybacks. Next slide. Here are my judgments. I projected sales to grow at 12% over the next 5 years. That's under the historical, a little bit under the manifest consensus and Value Line's projections. I've given them some margin expansion, but again, not as significant as Value Line is projecting. Taxes right at I used the Value Line 18.5%. The company's projecting 18. I went just a little over that, but right in line with company projection, and then come up with a $14.64 earnings per share 5 years from now, which then, so that was my growth and profitability projections. Now I'll add my PE and come up with total return projections. And here you have it. PAR, using the average PE of 19, comes out with a 14.3% return, just a smidgen over manifest. I think today was 13.9. And if the high PE is realized and you can capture that, it could return as much as 23%. So I'm tripling down, doubling for the second month in a row on MKS Instruments.
All right, thanks, Si. All right, I'm going to switch gears, and I do believe that it's, a fairly good combination with adult beverages and boats as long as moderation is practiced. And so Malibu Boats coming in at the top of the screen and joined fairly closely by Boston Beer. This is not a conspiracy. Ken, I hope we're not splitting the ticket and ushering Si into victory at MKSI by, coming in with these fun stocks. But what you're looking at is a screen of companies that have relatively high, superior quality and projected annual return, or PAR. So a high return forecast and a high quality rating in combination. And then I also limited it to quality ratings above 90, just because things are getting a little bit dicey out there. And you see a number of companies that have been discussed either here tonight or in recent months. And we tend to shop in these areas because it's got a pretty good long-term track record. So I'm not surprised to see all three companies on here. Not ready to go in for more tobacco, at least not tonight. Not ready for China yet, although China could be an interesting investment if you, again, do it in moderation and have, and maybe you have to close your eyes on that one too. We talked about LCI Industries this afternoon, a great company that's making a bunch of components for RVs. Gentex showing there, again, great company, good characteristics across the board. I think Gentex was tempting to all three of us here tonight. So just a number of companies that make sense. I am going to go ahead and go with Boston Beer just because it seems like an opportunity has been created by some market disruption. Here's the other reason, a couple more screens just to show you where some of these ideas come from. Looking for companies that are perhaps dramatically oversold is that top screen, as measured by the Relative Strength Index, or the RSI. Anytime that gets below 30, chances are it could be getting beat up by the institutions and the rhinos and the analysts. and just getting sold a little bit more than it should. I really get interested in when they drop below 20 and get into that range. But anything below 30 is interesting. And you can see the Boston Beer does show up here. Amongst these candidates, it does have the highest quality, a very decent par, and a projected return on value that's close to double digits. Morningstar thinks it's on sale, so it's just kind of resonating with me across the board. The companies down at the bottom, again, are top decile, very high quality companies with the highest projected return on value. We have had some of these here fairly recently. Green Tree is another Chinese company that could be an intriguing speculation at some point, but some of these other companies have been featured in recent months. But I decided to go with Boston Beer, and here's this is a snapshot from our stock selection feature last month, and it kind of presents the situation that's going on here. Samuel Adams makes, the core product, the Samuel Adams beer, but they also make a bunch of, they partner with microbreweries and that sort of thing, and they have these flavored seltzer waters and other alternative adult beverages. And the storyline goes that people seem to suddenly stop drinking the Truly product, the Truly hard seltzer. And this is not much of an exaggeration down here. I don't listen to a lot of conference calls on earnings reports, quarterly reports, but literally one of the company's long-standing favorite analysts asks the question and says, "It seems like you guys don't know what you're doing." That causes a bit of a stampede among the rhinos. And as it says here, they definitely ran for the exits. And, I was just sitting there thinking, and I actually don't have an answer to this question yet. If I come back with Sam Adams again, I'll get it. But I can't believe that the Truly or the hard seltzer products are that big of a component of the overall business. So even if that one is having a great deal of difficulty, they still have this core business of beverages that they have managed well for years. And just kind of a wild situation. Here's a look at the monthly stock prices going back 10 years, just to demonstrate that there are bumps along the way. There are some speed bumps and some fairly significant things. It does go flat every once in a while. Yeah, I meant that. But this recent downturn is fairly robust compared to some of the others in the past. Here's a closer look at the situation using a daily chart going back over the last year or so. And this kind of shows you a little bit of what's going on behind the scenes. We have talked here at the roundtable about what is referred to as a death cross. And that's when the short-term moving average moves through the long-term moving average. The blue line or the red line crosses the blue line, and you get this death cross situation. The reason it matters is so many of these institutions and rhinos follow this stuff. And as Ken has complained here repeatedly, sometimes it becomes a self-fulfilling prophecy. You cross through, you have this death cross moment, and you get a substantial decline in the stock price. And this happens for a number of companies from time to time. You can see that this has continued to slide. I think Ken mentioned an escalator formation earlier in the broadcast. This one is continuing to behave like a falling knife at some point. I got to believe that the company, it is well managed, and they do have a substantial product line, will catch itself and begin a recovery. Here's a look at the fundamentals for the company. You can see that a little over a month or so ago, it was in the 950 range, and now it has dropped down into the 570 price range. So it's had quite the haircut. It's down off of its all-time high fairly significantly. And again, I just have trouble visualizing how this problem with the hard seltzers can be that big of an issue, especially since I did some field research in northern Michigan last week and the week before that, and I witnessed a fair amount of consumption of the hard seltzer beverage. So, I mean, not everybody has stopped drinking them. So $2 billion company growing in the teens. So I'm using a 17% growth projection in line with value line. You can see that the profit margins on the company have been fairly steady, even if they have come back and rebounded off of these all-time highs, or if they're projected to come down from the originally high forecast. It's still a pretty good number. 11-12% for a projected net margin. The PE ratio has consistently been in the realm of 30. If those conditions are present, we are talking about a company with a 16% projected annual return. That reconciles actually fairly nicely with the projected return on value. So I'm not having a hard time seeing a company with some potential, and the company has literally no debt. It really has been beaten up, and I see it as an opportunity to play a little bit of a drinking game here and double down if necessary, but pretty good potential for the long term with this company. So with that, Ken, I think we can go to our poll. And we'll see if the audience will tolerate a vice company or a luxury recreation company, or they want to go with science.
The poll is now open, Mark.
And I think we're going to split the ticket, Ken. That's my prediction for tonight.
I'm going to give folks about 10 more seconds to vote. We're up to 85% of the audience voting. All you have to do is go over there and click which one you think we should add to the portfolio. And I'm going to close the poll and share the results. So Mark's absolutely right. Boston Beer and Malibu Boats took approximately equal shares, and MKS snuck through with 50%. We'll have to not allow Rsi to campaign next meeting, Mark, okay?
Didn't even need a runoff.
We didn't even need the runoff.
There's no ballot. Nobody's challenging. The results stand as printed right here, okay?
Wow.
So
completely obliterated.
Let's hide that and go on to the next slide, Mark.
You know, I think it's just proof positive that our audience needs to get out more and have a little more fun. Oh, good grief. All right, coming attractions. We will do a expected returns webcast this coming Saturday. We'll go over the components of the monthly newsletter. We do have a bull session next Tuesday. We do them all Tuesdays. I just put one on the schedule. Tuesdays at 2 p.m. If you're interested in that, we also archive those on that YouTube channel. Ken and I will be doing a broadcast from the Cleveland, well, not from there, for the Cleveland area. That's still a virtual situation. We will have registration details posted at Manifest Investing, and you can go to the Better Investing Northeast Ohio chapter to register for that event also on September 18th. Pretty sure that's a Saturday. Yeah, that's a Saturday. September Roundtable is a month away, September 28th, and we're still steering towards the National Convention in Dallas from October 21st through the 24th. I won't be sampling any hard seltzer when I'm down there, but I'd probably be willing to buy one or two for a few people. We can spend some time together down there. Any other thoughts, Ken?
We do have a couple of questions that we can look at after we close down the session, Mark, but for the most part, I have a hand in the air here. Sean would like to say something to you, Mark, okay? Sean, you're going to have to unmute from your side. Nope, you're unmuted now. Go ahead, Sean.
Yeah, Mark, you missed the best part of all that. A subsidiary of Boston Beer actually they plan on producing cannabis-infused beverages up in Ontario.
Well, there you go.
And to add to that, PepsiCo is also partnered with them to create a alcoholic version of Mountain Dew, which is actually, I believe, one of their #1 selling drinks. So those are two large things that could definitely bode well for Sam right now.
Yeah, this is a Mountain Dew can that you can hear in the background right now. So I'm doing field research.
That's what we'll believe.
So yeah,
Thanks, Sean.
that's cool. Thank you, Sean.
Get the information.
We'll if I bring it back another month, we will add to the story.
Okay, and we'll look at a few questions after we close down. But
Right.
for now, I'd like to thank everybody for coming. Wish you all well, and hope we see a lot of you at the September Roundtable on the 28th of September. Thank you, Cy. Thank you, Mark, and good night, everybody.
You're welcome. Take care, everybody.
You're welcome. Good night.